Let's talk about growth versus value stocks. What is the difference between growth and value stocks? Very simply put, growth stocks are thought to have more future potential. It's believed that they can expand and deliver outsized returns relative to the market. So, future potential is the idea of a growth stock, the big idea, I would say. Value stocks, on the other hand, tend to be more established companies, but the idea is that they present a value in that they are trading lower than their intrinsic value, trading below. And of course, I'm going to put the term intrinsic, oh, and I'm sorry, this isn't even on the screen, intrinsic value in quotes, because there's a lot of debate about whether that's even actually a thing based on efficient market hypothesis, et cetera. But for our purposes, we will pretend that it's actually a thing as described. And the idea is that eventually the market might catch up. You've identified, you're getting more value based on what these companies are doing. Eventually the market will recognize that value and the share price is going to go up, okay? An example of a growth stock would be something like, potentially, Tesla, which I used to be an investor in and have substantially divested myself from. Investors may believe Tesla could, in time, compete with the likes of Ford and Toyota in terms of how many cars they're able to sell, maybe get their price points down to increase sales. They could develop battery technology and transform into more of a tech company like a Google or Apple. And the idea is there's a huge entire expansion that could take place, which makes it a growth stock rather than a value stock. An example, value stock might be something like Bank of America. They've already achieved most of the growth they're going to get as a company. They're one of the biggest banks around. Maybe you look at the financial statements and you decide based on a number of metrics, their stock should be worth $100 a share instead of $60 a share. It doesn't matter what the real values are. So you buy it thinking over time, I'm going to profit off of that difference. It's not Bank of America is going to figure out a way to double the number of branches or whatever the case may be, or double market share. It's worth more based on the financial statements than where it is currently trading. The stock market is full of both growth and value stocks, but different industries tend to have more of one or the other. Like the tech sector, along with consumer discretionary trends, consumer discretionary tends to have a lot of growth stocks, whereas consumer staples, big financial companies, they tend to be more value type stocks. Both contain risk because individual stock picking is risky. I don't even engage in it except with the tiniest portion of my portfolio. I want to be in broad index funds. Now, there's another layer to this between picking value and growth stocks and just having super broad-based index funds, which is you can find an index fund or you can find an ETF that includes growth stocks or includes value stocks. That cuts down the risk. It also cuts down the reward opportunity. Typically, an individual value stock will be less risky than an individual growth stock because by definition, the company is larger and more established, but the possibility of going 2x, 10x, 30x is going to be a lot lower. Dividends. If dividends are important to you, you tend to see the dividend much more under the value stocks. Dividends higher or existent, and on the growth stock, dividends tend to be lower or non-existent. The dividend guarantees a certain amount of return, but it could come at the cost of a shrinking valuation over time. So you may not end up making as much as you thought maybe you would, particularly because you pay taxes on the dividends. You could also go wrong with a fundamental analysis on a value stock. Maybe it's not intrinsically worth what you thought it was. So there's that level of risk as well. At the same time, growth stock can be very risky as you're counting on more aggressive innovation and expansion, which may not be possible, or there may be changes to the marketplace. Unforeseen economic factors may hinder growth ability, whereas the idea is a value company is going to be less impacted by that. There have been periods over the long term where growth overperforms value, and there have been periods where value overperforms growth. If you're picking individual stocks, at least understand these concepts. These are not the only ways to pick stocks. If you invest passively with mostly broad-based index funds the way I do, you're getting value and growth stocks in your index funds already. You don't even have to worry about it.